Well, last week wasn't really a big week for the markets. We saw a lot of different sectors were quite volatile, but in the end, the broad markets really didn't change that much. This week, it could be a little bit different here. We're entering into October this week, and October is a volatile month. In fact, it's the most volatile month of the year on average, but it tends to be positive. So tend to see a lot of volatility. But some of those, if we see a dip, it can lead to buying opportunities here as well. This week coming up, I think the big news is going to be the Nonfarm Payroll number on Friday. We've seen some weaker than expected reports, and we've seen some really big revisions take place. And so there's not a lot of faith in the numbers from the BLS for this report. But, we'll talk a little bit about that. Let's start by taking a look at what the price action in the markets was last week. Last week, we saw the S&P 500 down 0.3%. The big story of the week was the energy sector up 3.9%. It's been a little volatile. Now, the caution on this is that we're entering into October, which tends to be one of the weaker months of the year for the energy sector. So we could see that pull back a bit. We saw materials down last week quite a bit, which is interesting. It's now, this material sector in the U.S. is made up of mainly of chemical companies. Is the biggest composition of that. So it's an indicator of the economy somewhat. We saw utilities up 2.2%, which is very strong given that we saw consumer staples and healthcare negative for the week. Now, what you can see here is utilities outperforming before volatility picks up. It wouldn't be the first time that that's happened if it happens in October. Well, we'll have to wait and see on that one. If we take a look at some of the other markets here, last week we saw the TSX, the Canadian stock market was flat for the week. Emerging markets down 1.1%. China was down 0.8%. The NASDAQ, so we saw technology off 0.7% last week. Some of the cyclicals did quite well. We saw metals and mining up 2% last week. And the big story here was silver up 7.2%. Now, silver tends to perform well in September, but not October. Tends to pull back here a little bit, so we could see a little bit of a pullback. But there's a lot of hype around silver right now. A lot of investors are looking for the sector to be squeezed higher, so we could see further action higher, but it tends to be weak from a seasonal basis in October. Gold miners were up 3.2%. Gold was up 2% as well. I want to point out, after performing really well for a few weeks, uranium did have a slight pullback. In the grand scheme of things, that's been a small pullback compared to what we have seen as far as gains recently. And here's the Canadian market here. You take a look here. Technology was the big loser, and that was pretty broad-based. Sometimes you'll see the sector be pulled down just by Shopify, but we saw the technology stocks actually perform poorly last week. The material sector here, now that's mainly gold miners, was up 4.6%. Energy was up here as well, 2.9%, helping to see the Canadian market move higher, or I should say end up flat for the week. This is the top 10 performing stocks in Canada last week, and the bottom 10 performing stocks. If we go down here, we can take a look at Constellation Software, down over 17%. Go Easy was also down quite a bit here, down about 15%. Then we go up to Shopify, it was down almost 8%, and Lightspeed down over 7%. So we did see that wide-based sell-off on technology last week in Canada, pulling the market. It ended up flat for the week, despite having a really strong energy sector. Here's an interesting metric I came across here. This is the last 20 years, and we're looking at the 75th percentile to 25th percentile. That's the box here. And this is the 20-year median, that's the line here. And then the tails here, that would be the, in this case, the 95th and 5th percentile. So the bottom tail here and the top tail here. And you can see that here we have the NASDAQ 100 at 29 times PE ratio. The Russell 2000, in contrast, this is the interesting part. If you take a look here, is at 25 times. And so we're really hovering about the 75th percentile versus the 95th percentile for the Russell 2000. Look at the S&P 500 at 23 times earnings here. You can see that this is really in the top percentile here. It's just a story showing how lopsided this market has become, and we could see things change over time here a little bit, and we could see more rotation take place. We're starting to see some of the rotation into some of the cyclical sectors of the market, including in the US as well. There's a lot of talk of the US dollar performing poorly in 2025, and that was in the first half of the year. We did see it pull back here a little bit relative to world currencies as well. But if you take a look what's happening here, you have to watch out for the narrative on this, because it's not as bad as what it really seems here. Maybe the US dollar's actually finished pulling back, and I've talked about this in previous videos here. So I'm using a post from Robin Brooks here, and he does some good work here that I do follow. If you take a look here, this is the trade-weighted dollar, DXY, and this is the two-year forward rate differential between the US and the G10. And all that's measuring is the expectation. The reason why they're using 2 years, because that's the central bank really effective, or where they're really affecting the curve on the market. And if you could take a look on the expectations, 2 year is basically saying, what do we expect in 2 years over the next 2 years after that, as far as the 2-year rate goes. And you can see here, the US is actually moving higher here, the US 2-year rate relative to the G10. Which means that the expectation is the Federal Reserve will cut in the markets. There's been a lot of rhetoric about that, but we're starting to see an expectation that maybe not so fast as other members of the G10, which would be supportive of a stronger US dollar. I also just wanted to follow up on gold here as well. This is gold ETFs, okay? And if you can see here, it was 27 tons flowing into on gold ETFs on Friday. And we have to go really back to, well, back into 2022 to see this. And this was a one-time here. We did see it pull back up here. It's going to be interesting to see if this continues to move higher. North American investors really haven't been big buyers of gold and ETFs yet compared to the rest of the world, or particularly in the East as well. So we are seeing some support here. Gold has done extremely well in 2025. Word of warning here is October does tend to be one of the weaker months of the year for gold, bullion, and also gold miners. I just wanted to put this yield curve on here to show you what's happening with the interest rates as of today. So this is here in blue. This is what the yield curve looked like on April the 1st. So that's this curve here. And you can see that the yield curve going down to the red is the current rate here. So if we take a look here, at this point in the curve, 2 to 3 years, you can see it's dropped substantially, which is what you would expect with the Federal Reserve actually cutting rates. At the 10-year rate right here, it's actually the same in that time period. Now, it's actually 10 years actually gone up since May, but as of April here, we can see that the yield has been the same. But look at this. This is what's really interesting here, is you can see that the long-term rates have moved higher. If we're looking at the 20 to 30-year rates, they've actually been moving higher as the yields on the short end have been coming down. So this is steepening the curve. This week, if we take a look here, the non-farm payrolls expectations is for 50,000. The previous was 22,000. These are really, really weak numbers. Really, what you want to see in the U.S. economy to show strength is, well, anywhere around 250 to 300,000. We're well below that. If you take a look at the unemployment rate is expected to remain at 4.3%. And the last rate was 4.3%. Now, I do want to say that there's been a lot of different movement as far as the immigration situation and labor participation rate. And if you factor in just the labor participation rate and its changes, one calculation says that the unemployment rate would actually be 4.9%. So this number of 4.3% is not quite as good as what it's showing here, but it's going to be an interesting thing to watch here. The BLS has made a number of revisions to its employment numbers over time, and they've been really, really large. And there's a lot of question about the non-farm payroll number and its validity. I'm not going to go into all that today, but I do just want to point out this graph here. If you follow the white line down, which is really the total here, and this is the important part, this is the trend. It's lower. Okay, that's just lower. That's not good. Yes, maybe they do beat here a little bit the expectations or whatever, but the trend still is lower. Really, we want to see the trend start to move up higher consistently for the U.S. to show labor strength, and that's not the case right now. Consumers expect the unemployment rate to rise, and also as well their predicament as far as their personal situation employment. And you can see that showing up here. These are quite high numbers here. If you go back, these are really recession type numbers that we're looking at here. So there's a lot of pessimism around. The numbers just haven't shown it yet for the headline numbers for unemployment in the U.S. Here's a graph of the ISM numbers that this report's being released this week. This is for manufacturing here. This line here for 50 is means above 50 is you're expanding in the manufacturing area, and below 50 means you're contracting. Now, there's been contraction for quite some time here, a little bit of expansion over in this time period here, but the manufacturing side has been weak in the U.S. Now, services has made up for that somewhat. We are expecting this week to actually see the manufacturing still to stay below 50 at 49. So we're expecting it to tick higher here a little bit, but still not very strong at this time. And here's a graph of the ISM services, which is also being released this week here as well. PMI numbers, and you can see here that in this case, there were a few exceptions where we did see this number tick below here, below 50, to show some contraction, but you can see here that we are above 50 at this point, and if we take a look here, the expectation is to be at 51. The last was 52, so we're actually expecting to see a little bit of a slowdown on the services side this week. But despite these U.S. numbers, I really think the non-farm payroll number is going to be the big number that everybody's going to be watching. And there's going to be a lot of debate about, is this number real? Is it going to be revised once again, et cetera, et cetera. For Canada, the PMI number coming out, the manufacturing PMI is coming out this week here. And you can see that the last reading, this is exactly the same. So here's 50 here. This is means expansion, and this is contraction below. So what this means is we're in the process of seeing contraction still, but the speed of the contraction is slowing down at this point. We're still not in positive territory. Now you can see that we have seen this pattern take place here for this. So, and the Canadian numbers can be lumpy, but we are still really overshadowed with that really weak GDP report of negative 1.6% last quarter. So that's really what investors are focusing on. So if we do come in with lower numbers, that could also just re-emphasize that report a bit and perhaps put more negativity as far as the Canadian economy goes. This graph shows that October tends to be the most volatile month of the year. And if you take a look here, it's 33% above the other 11 months, and that's going back to 1945. You can see that strong trend here. Now, I've actually done some shorter term studies, 20 years, 50 years, etc. And October tends to be one of the most volatile months of the year on implied and actual volatility as well. Volatility tends to peak in October, so it can provide some good opportunities if we do see a downpull in the market to actually start to step up as far as beta goes. Now, the market's been performing well in a period where it tends to be weak on a seasonal basis. And so that makes it a very interesting situation. We've just seen a lot of hype pushing this market higher here. And perhaps we do see October also follow through on that. But it is a warning that we can see some volatility in October. There's nothing that says that's going to happen specifically this time around, but it is a trend that investors should be aware of. We're in the transition week between September and October for the stock markets this week. Now, we've seen the stock market performing well in September, which tends to be a weak month of the year. That didn't happen. We saw the stock market move higher. This has really been a lot about the markets climbing a wall of worry and really going against seasonal trends here as the market gets pushed higher and higher in relative valuation. October, the first few days in October tend to be positive for the market. Now, we can see sometimes after a strong month, we can see the market actually flip the other way and start to move down as investors really reconsider what's happening in the markets. So we have that counter-narrative trend that takes place. I'm not saying that's going to happen here. We are seeing some positive trend for the markets at this time. In fact, the first part of October tends to be strong heading into earnings season. It's just after earnings season gets underway, which is around mid-October, when the U.S. banks kick off their earnings, that we can start to see the market get some trouble here. So once again, this is going to be an interesting week coming up. I think investors are really going to be focusing on the non-farm payrolls. And I think that can be the narrative switch, perhaps, if we do see a really weak non-farm payroll number come out. And also, we've seen some very strong economic reports recently, so maybe we get a stronger number coming out from the non-farm payroll number. But if it's too strong, that means the Federal Reserve will really start to cut back their expectations of cutting rates. As well. So really, investors are probably hoping for that Goldilocks number to come around 50,000 as far as jobs being created in the month of September. But I think it's still going to be an interesting pivot point for the market coming up on this Friday. Please like this video and also consider subscribing to the channel so you get regular updates. Thank you very much.